All right, welcome back. Today we're going to decode one single number that tells you if a stock is more of a roller coaster or a lazy river. I'm talking about beta. It's kind of like the secret language of market risk, and understanding it is absolutely key if you don't want to get caught by surprise. So what is this powerful little Greek letter really telling us?
Well, it all starts with a really fundamental question. As an investor, right, you can pick your stocks, you can choose your industries, even the countries you invest in. But there's one thing you just can't escape: the overall tide of the market itself. So how in the world do you measure your exposure to the one risk that, well, affects everyone?
Okay, I love this analogy. It just makes so much sense. Imagine the market is like the weather. Sometimes it's calm, other times it's a full-blown storm. Well, beta, that's the instrument on your pilot's dashboard. It's telling you exactly how much your specific investment is going to get tossed around by those winds. It's literally your guide for navigating all that turbulence.
Okay, so let's break it all down. What exactly is this financial compass measuring?
So here it is, the textbook definition. Beta measures a stock's sensitivity to something called systematic risk. Now, that's just a fancy term for the market-wide risk that you simply can't get rid of, no matter how much you diversify. To put it really simply, if the entire market goes up or down by 1%, beta tells you how much your specific stock is expected to move right along with it. It's that direct. So what's our baseline? We have to measure this against something, right? Well, by definition, the overall market, think of something like the S&P 500, has a beta of exactly 1. That's our yardstick. Every other stock or investment is measured against this benchmark of 1.0.
And this chart just lays it out so clearly. Let's take a look. A stock with a beta of 1.5, like this aggressive stock here, is expected to be 50% more volatile than the market. So if the market jumps up 10%, this stock could shoot up 15%. But, and this is the important part, if the market drops 10%, it could fall 15%. On the flip side, you've got this defensive stock with a beta under 1, and that's going to give you a much, much smoother ride.
And you see this play out in the real world all the time. Think about it. Those high-flying tech startups, they often have really high betas. They'll rocket up when the market's good, but man, they can get hammered in a downturn. Then you've got the other end of the spectrum, like utility stocks. Their betas are usually low because, well, people need to keep the lights on no matter what the economy's doing. And get this, you can even have a negative beta. That's for things like inverse ETFs or sometimes even gold, which are designed to move in the opposite direction of the market.
Okay, so it's one thing to be able to measure this risk. But so what? How does this little number actually help us make smarter investment decisions? Well, that's where beta's most important job comes into play, as a crucial piece of one of the most famous models in all of finance.
And here's the big secret. Beta isn't just some standalone risk score you look at in isolation. Nope, its most important job is being a key ingredient in something called the capital asset pricing model, or as everyone calls it, KPM. And this is the model that tries to connect the dots, to draw a direct line from how much risk an asset has to how much return you should expect to get from it.
So let's deconstruct this thing. The formula starts with the risk-free rate. Just think of that as the return you'd get on a super safe government bond, basically zero risk. Then you add what's called the market risk premium. That's the extra return you expect just for being in the market in the first place, instead of sticking with that safe bond. And now here's the magic part. You take that premium and you multiply it by the asset's specific beta. It's that simple. A higher beta means you should demand a higher expected return. It just makes sense, right? More risk should mean more potential reward.
Now this formula isn't just for number crunchers and spreadsheets. No way! When you actually plot this out on a graph, it creates this incredibly powerful visual tool that every single investor can use. And what you're looking at here is the result. When you take that CAPM formula and graph it out for every possible beta, you get this perfect straight line. It's called the Security Market Line, or SML. And really, it's just a picture that shows the trade-off between risk and the return you should be expecting.
Don't let the graph intimidate you. Reading it is actually super simple. The vertical axis, the y-axis, that's your expected return. The higher up, the more return. The horizontal one, the x-axis, that's your risk. That's beta. The further to the right, the more risk. See where the line starts on the left? That's the risk-free rate, basically the return you get for taking zero risk. And the slope of the line, how steep it is, that's just showing you how much extra return you should get for every extra bit of risk you take on. Okay, and this is where the SML turns into something like a treasure map for investors. At least, that's the theory.
See, any stock or asset that plots above that line could be a potential bargain. Why? Because it's offering a higher return than its level of risk says it should. On the other hand, anything that falls below the line, that might be overvalued. It means you're not really getting paid enough for the amount of risk you're taking on.
Now, the CAPM model, it's beautiful, it's elegant, but it makes one huge assumption. It assumes that the only risk that matters to investors is that broad market risk, the one measured by beta. But is that really true? Is the market the only thing that matters? And that question, that little crack in the theory, is what led to a whole evolution in investing. It pushed just beyond just thinking about that one single factor and into a much bigger world, a world we now call smart beta. So here's the big shift in thinking. Traditional index funds, right, the kind that CAPM was designed for, they just weight stocks by size. The bigger the company, the more of your money it gets. Simple. But smart beta comes along and challenges that whole idea. It asks, hey, what if we built our portfolio based on other things, other factors that have historically given us better returns or maybe even lower risk? And this is what some of those other factors look like. A smart beta strategy might focus on value stocks, ones that seem cheap compared to how much money they make. Or maybe momentum stocks, the ones that have been on a hot streak lately. You could also target quality companies, the ones with really solid finances. The whole point is to build a portfolio with a much more specific, targeted strategy, instead of just buying the entire market.
Okay, so with all these new, fancy, smart beta strategies floating around, you have to ask, does the original classic beta even matter anymore? And the answer is absolutely yes.
I think this quote just nails it. Even with all the complex strategies out there today, beta is still the essential starting point. It's the foundation. It gives you that core understanding of how an investment relates to the one risk that nobody, and I mean nobody, can avoid, the risk of the entire market. All right, let's bring this all home. What are the key takeaways? First, beta is your gauge for market-wide systematic risk. Second, it's the absolute core of the CAPM model, the thing that connects risk to the return you should expect. And third, understanding it is just crucial for building a portfolio that actually fits you. And yeah, while it's not perfect and new ideas have come along, it is still, without a doubt, a foundational concept that every investor needs to get. And that really brings us to the final and maybe the most important question of all. And this one is for you. We've just spent all this time breaking down how to measure an investment's risk relative to the market. But the real work? That starts when you turn that question back on yourself. You know what beta measures, but what's your risk tolerance? How much turbulence are you really willing to handle on your own financial flight?